Welcome everybody to this Mintech webinar entitled The Power of Commodity Forecasts. I'm Spencer Wicks, CEO of Mintech, and it's my great pleasure to join you and introduce the session today. Mintech is a leading commodities price and analytics company focused on the food sector. And in response to many client requests, we've recently added a new price forecasting service to our platform, which is available today. This has come about through the recent acquisition of Kairos Commodities, which had developed a formidable track record and reputation in forecasting and helping professionals in procurement and risk management to time their purchases and avoid unnecessary costs. To showcase our approach and a system, we'll be providing you today with examples of forecasts and hedging recommendations across 3 individual commodities. And with me, I have Mintech's Chief Analyst, Tom Bundgaard, who leads our team of forecast analysts. So Tom, let me hand over to you now to begin the presentation and demonstrate to everybody the power of commodity forecasts.
Thank you, Spencer. Great to see you all in this webinar. Let me switch over to the screen so you can see the Mintech Analytics. So I'll walk you through a few commodities so you sort of get the hang of it. We won't go terribly deep, but just so you get a flair for what's happening and how it's working. The shiny new button is here, Forecasts. I realized that this button is actually doing the same as all the rest of the buttons. I mean, they're here to help as much as we can. We have a big job working in procurement, and forecast is just one of the things that will help us. So let me show you how that works. If you click on forecast, what you'll be seeing is a number of products that we forecast. So we have animal products, so we just do it in alphabetical order. Animal products, we got currencies and freight, got different energy like crude oil and gas. We've got grains and oilseeds. We got a lot of metals from London Metal Exchange. We got a lot of plastics to cover, packaging. And we've got a lot of soft commodities, sugar, cocoa, and then we've got a lot of steel. So those are the products we have right now. And of course, over time, we will add more and more commodities to this list. So stay tuned for those. I will try to do, I was asked to try to look at soybean oil as an example. And maybe we can take container rates because they've been going through the roof. And maybe have a look at the plastic. It could be polyethylene or PP, sort of just to give you a flair for how it's working. But I'll use the prime time here on soybean oil just as a showcase example so you see the modeling behind it. So one of the principles that we're doing in this, we don't want you to spend hours and hours reading stuff only to wait to get to the conclusion at the very end. So we're turning it upside down. We want to give you the conclusion right away. So if you click on soybean oil, for example, what you'll be seeing is a nice chart here with the price, and you'll see some targets. So you can see that target 7 is just done, and prices are now most likely heading to target 8. That's the dotted line into the future. The future is always somewhat dim. I mean, you can't forecast this precisely, but that's our forecast up to 8 and then down to 9. So target 8 up here is saying, 78 to 84. I mean, this range, low, medium, high range, with a Q4 peak. So that's the forecast, and you can see our previous forecast, like 6 and 5 and 3 and 2. You can see them back in time, how well we hit them. And you'll be able to see this one because this is the operative target right now, and that's fixed. We're not allowed to move the operative target. I mean, I can move target 10 if I want to because of new things, but target 8 is fixed there. So you'll be able to see whether I hit it or not once we get to there. So that's the overview. So if you click down here in the bottom range here, you'll see forecast. This is where the modeling is done. So what we want to get to, right, is a conclusion. That's the pinnacle here. That's the forecasting. So this is where the conclusion is. So if I click on that, you will get the same targets here. So I typically say we give you sort of a 3-second view. We can give you a 3-minute view, and we can also give you a 3-hour. Well, that's probably a little bit too much, but at least 1-hour view. It depends on how much you want to see. The more you want to see, we have it all. You can go as deep as you want, but you don't necessarily need to go really deep every single week. So sometimes 3 seconds is enough. And the 3-second view is this, it's going up. If you want the 3-minute view, there's sort of a condensed text here that will just explain to you the overall modeling and what is going to happen in target 8 and target 9 and so on. And at the end down here, you will find our hedging recommendation. So yes, we actually do advise you actively to do something. That means we need to have very broad shoulders, because if we advise you something and you save a lot of money, of course, that's your gain. But if we advise you something bad, you will come to us and say, why did you do that? So we need to have very broad shoulders. But basically, we're saying avoid hedging, or we can say now we're about to start an uptrend, so you need to make plans. And then here, when we go to hedging, we have a sort of a preliminary hedging with partial volume. And then when we have the full signals and the objective signals, we go to full volume hedging. And every time we switch this arrow here, we will send a notification to you. So when that is shifted to full, you'll get a mail. And when it's shifted to avoid, you'll get a mail. So you just sign up in the notification box. And you don't need to get it for every single commodity. You can just choose the commodities you're interested in. So you only get a notification for those. So that's sort of the 3-minute view. So as you can see, we did say partial hedge. So in early October, we said do a partial hedge for the rest of Q4. And we're waiting for the full hedge. So that's the 3-minute view. If you want the full view, you've got our modeling here. So this is the pinnacle, this is the result. But in order to give you these targets, how do we make those targets? Well, we need to make like a pyramid here. So that means you need to have building blocks to make this. One building block is understanding supply and demand, and the supply-demand balance, market watch, inventories, cost drivers. That will give you the fundamental view on how the situation is for, in this case, soybean oil. But one model is not enough for us. We need desperately to have more models, and that's why we have mathematical, this is called technical analysis. It's a mathematical view of the price movements. And that's not enough. We need a macro view. We need to understand how this commodity reacts under certain macroeconomical conditions. So what we're doing at the end is we're combining all of these 3 modeling and pushing that into forecasts here. That's our methodology. And we don't want to act on one model. We want to have a unified, evidence stacking that all 3 models are telling us the same thing. So let me give you a quick example of how this looks, because we need to push a few buttons so you can see how it works. Let's say we're interested in the fundamentals and you want to understand inventories. So in that case, you click on inventories, and you can see there's a lot of different graphs, and there's too much to cover here today. But the basic view is inventories here are dropping. And when inventories are dropping, that's a bad case. That means prices needs to go up. So there's an upward pressure on price because inventories are dropping. And not only are they dropping, they are almost historically low right now. So that means there's a very good reason why soybean oil prices are so high. So that's a look into inventory. If you click I don't want to click them all, but just give you a brief flair for this. If you click on Market Watch, let's have a look at, let's have a quick look at seasonality. Typically from a September low, you typically see an increase until December. So we know from a seasonal perspective, we are at risk here in Q4. I mean, seasonality doesn't repeat every year, but there's a rough outline to it. If you take to 2021, that's the black line. So it's followed more or less roughly. So from here, this is September. I mean, there should be some kind of increase for the rest of the year. Not only that, a lot of people ask us, what about the speculators? What do they do? Well, you can see them here. We are tracking the speculators. So in this case, I'll just enlarge that screen and show it like this. That orange line is the speculators back to 2003. So this is part of the fundamentals, and we analyze the speculators just as we analyze anything else. If you put soybean oil prices on it, from a low speculative level where prices are low, you've seen a magnificent increase in speculative interest, and of course that is pushing prices high. Right now, you're seeing a decline in speculation, and that's why we've seen a decline in prices. So this is part of our modeling. And of course, we know that they are not synchronized. So typically we see speculators make a peak before prices make a peak. That's called a lead-lag relationship. So we study these lead-lag relationships. You have the same over here, speculators peak and then prices peak. Speculators peak and then prices peak. So we understand there's a lead lag, whereas low points, typically they're aligned. So a low point in speculative is typically aligned with a low point in price, but all of this is something we study. So speculators is just one of the things we look at. So I need to go to the modeling here, just a second. Here we go. So now that you understand like inventories and seasonality and all of these factors are put into our regression analysis, cost drivers, supply, demand balance, everything is put into the conclusion. And that conclusion takes into account that these factors move, but also that some factors are weak and some factors are really strong affecting the market. And we can calculate that mathematically. So the regression analysis looks like this. This gray band here is the fair price that we calculate. So this is our proprietary way of calculating things. So we look 20 years back and look at how the market is reacting to this. And the orange line is just the middle point. So if I look at this, I basically get two things out of this. I get the level and I get the trend. So I understand this price here, that black price, is fair because it's inside the fair band. So I understand that the level is fair. But I also understand this level is too high, this level is too high, and I understand the current level is too high. These are bubbles. I call that a bubble. So, and there's a specific reason why these are happening. If this was the stock market, you would call this an exuberant stock market, but this is commodity. So this is called panic. Panic tops are because buyers, and I used to be a purchasing manager myself. I've been a purchasing manager for many years, buying all kinds of commodities. At these tops where prices are above the fair band, do you ask the supplier about what it costs? No, you don't. You don't care. It's about, can you deliver? And cost is besides the issue, because if there's a shortage of goods, and it's just about, if you can't get delivery, your own factory will shut down, and that is not a good way to invoke the intention of the CEO. So panic tops are formed in the same way, and they function in the same way every time. So we can study past panic tops and understand how this one will work as well. So that's the level. But also the trend. We understand that this is sort of a weak sideways, slightly downward trend, but then we have a turnaround here. I'm particularly looking at the turnarounds like here and here. So if I just do this point here is summer last year. And that was a turnaround leading to an uptrend in the fair band. So if I just enlarge it again, this is a turnaround and the fair band was moving up here. And there's only one response to that from a fundamental point of view. Prices needs to go up, and in this case, make a panic top. Now the fair band is going down. But let me get to that when I get to the current situation. So the fair band is actually telling us that there's a downward pressure and prices are too high. That means that prices needs to go down. So already here with all of this, we get a solid understanding of what are the fundamentals right now and what is the conclusion of the fundamentals. But then I need to understand the macroeconomy as well. So I'll click on the macroeconomy. And the short way to explain this is that this orange line, it's the global PMI. It's basically the same as GDP. Take my word for it. I can show you in another webinar, but GDP and PMI are totally close together. This is the big decline we saw last year because of the Corona situation, the lockdowns. And since then, we've seen a massive increase in the economy. So how does that kind of thing affect soybean oil? Well, what we're doing here is that we can, I just need to show here a second. So the line that you're seeing here, soybean oil prices. So like that, sorry. That black line is soybean oil prices. But when the economy is going up, soybean oil prices have to go up. And when it's going down, prices needs to go down. Even this little blip here is giving an increase and then a decline again because of this. So is it any wonder that such a big increase in the economy, what can it do to prices? It can only make prices go up. And currently there's a little bit of decline and that is reflected in prices. So basically, you now have a good understanding of the macroeconomic impact as well. So the final thing we need now to be sure that all three models are aligned is we need to have a look at the technical analysis. And that is over here. So to keep this short, we're looking at the short term, we're looking at ultra short term, we're looking at medium term, and we're looking at long term. So let's just keep it simple for now and focus on the long term. So here, and so what I'm looking at is the technical analysis signals. And that black line you're seeing here is called a moving average. So I'll just take the whole time frame here. That black line, when prices cross above that black line, and that you can see that happened in June 2020. So you can see that down here. Cross above that black line is what we call a buy signal. That means that prices needs to get into 1, 2, or 3 years of uptrend. The barest minimum is 1 year. And it's very rare that it's so short, but typically it's 2 years, but it can easily last 3 or more, but at least 1 year is the barest minimum. So that signal is the same signal we saw over here. It's the same signal we saw over here. And what needs to happen is an increase like that, or an increase like that, or in this case, an increase like that. So it's following totally the same pattern that we've seen many times before. So that is the technical analysis for you. So let's now try to sort of summarize them. So we've got, I just took a screenshot. We have the macroeconomy, we have the fundamentals, and we have the technical analysis here. So let's divide it up into the uptrend from last year to now, and then into a decline later on. But let's focus on the uptrend. The economy was going up, fair band was going up in the fundamentals, and we've got a break above the moving average. showing that this is a 1 to 3 year uptrend. Basically, all three models were telling us the same thing: prices needs to get up. And that's why we've seen such a strong increase until today. Even creating like a really a bubble where prices are too high, a panic top. So that's explaining that the models agree about that uptrend. They have agreed all along, and that's why we've hedged a long time. So basically, if you want, you can go back and look at our hedging recommendation. Last year, we advised to hedge all of 2020 and all of 21, like 1.5 years as a minimum. A part of 22 could be hedged as well, but we did that last summer because we could see this. Now, if we look into the future, what we are looking at is somewhat of a decline. Well, basically a little bit down, a little bit up, and then a bigger decline. So why do we have that view? Well, first of all, the macroeconomy is falling over here, and the fair band is now starting to fall. And that means prices needs to get into this level here. Not straight away, but in due time. So that gives a downward pressure. And the final thing is that the technical analysis is showing that we're hitting a peak. And I'll show you how that works. So let me just delete that. From a technical perspective, show you that. We have loads of webinars on this. The RSI, this 80 line is a mathematical way of showing you peaks. So if the RSI is 80, you are at a peak. If the RSI is 80, you are at a peak. Every single time it shows you that you are at a peak. And that's where we are right now. The good thing about this is a low peak. This is an extremely high peak. This is a high peak. This is a low peak. This is a very high peak. The peaks are coming at all kinds of levels. But the RSI reduces that and says whenever you're hitting RSI 80, you are at a peak. And that means even though this peak over here was very, very small, when you are at 80, you're not supposed to be doing long-term hedging. That chance is over because you're at a peak now. If you do hedging here, stretching far into the future, you're just locking in prices at a peak. The same goes here. The RSI has told us this is a peak. Don't lock in prices on the long term. So we can easily get like fluctuations here. So sort of a little bit of sideways fluctuation. We expect the same thing here because down and then a little bit up to Q4. That's why we're doing a short hedge covering Q4. And then we're going to see a massive decline. But that's not due until next year. So if you go to the technical analysis here, on the short term, this is very short term, target 8. Here we're just looking into Q4. So on the very short term, we want you to hedge Q4 just to get rid of that upside risk. But we don't want to do really long-term hedging. That is reserved for here. This is long-term hedging, what we did last year. This is long-term hedging. This is long-term hedging. So that's where you really go wild with hedging. And by hedging, some people misunderstand. I'm not talking just financial hedging. I'm also talking contractual hedging with a supplier. I'm talking physical hedging, and I'm talking structural hedging. Whatever type you're using is up to you. I mean, we just advise you that you need to mitigate the risk by doing some kind of hedging. But it's up to your risk and hedging profile. So the last thing I want to say about soybean oil is we typically see if we have a peak over here and we have a peak here and we have a peak over here. Now, those are 3 different peaks. And then you get a temporary decline and you get a temporary decline. And that's what we've had here. And because Q4 is a seasonal strong upward pressure, it would make sense to see like an increase here, like an increase here, and a seasonal increase to Q4, and we need to hedge that. But then once that is over, we need prices to get into the fair band. And from here, we need prices to get into the fair band. And the same thing is going to happen here. We're going to see a massive decline into the fair band. But not just yet. We need one more Q4 increase before that is over, and then it will go down. So the big decline is for next year. So I hope that sort of, and we didn't go into all the specifications, but I hope this is sort of an overview of how we model things. And I think the best way to show that would actually be to take another example. So if I go to, I can pick anything. Let's take polyethylene. Here you've got the targets. If I go to the forecast here, again, the pinnacle here is saying forecast. So the text is saying that basically, if you look at the avoid, it says avoid hedging. Why do we say avoid hedging? Because prices are falling basically until target 7. Yes, it's going a little bit down, a little bit up, but basically going down to target 7. That target 7 low point is scheduled to arrive in Q4 between 1,800 and 2,000. And right now we are at 2,188. So we avoid hedging while prices are dropping. And it may take a little while longer. And then when we're there at target 7, we expect a target 8 increase into Q1. And that's, if the signals are correct at that time, then we will advise you to cover all of Q1, mitigate the risk so that you don't get that price increase. You can see it's structured in the same way. And the pyramid is structured in the same way. So if I look at the macroeconomy, what does a macroeconomic uptrend do to prices? Well, they go up, just like soybean oil. And even this little bit of decline here is making polyethylene go down. So you can see it has a very strong correlation. That's why we need to understand the macroeconomy. What about the regression? You can see that polyethylene is making a very, very strong, increase. The fair band is going up, but this is a very big bubble, bigger than we've ever seen before. All commodities are doing that right now. And for example, if you go to, let's say, cost drivers, well, you can have a look at the cost of producing polyethylene. So let me just go here. More or less, this will tell you that if cost prices goes down, of course, polyethylene goes down. And this increase should make prices go up, which they did. But prices just went way higher because of that supply-demand issue. And that shows you, basically, if the difference between these two is profit, that's the orange line. So let me try to do this. The orange line is profit. So we calculate the industry norm. This is the gray area. That's the industry profits. So we realize that sometimes profits are too high, sometimes they're too low. This is danger for me as a buyer, because when profits are too low, of course, profits needs to go up, and that means rising prices. But this is a too high price, too high profit. We can see that this profit is way too high. And buyers like you don't allow that to happen for too long, only when there's a supply issue. Once that supply issue is gone, profits will automatically return to the norm, which has been the norm for the last 20 years. So prices are going to decline in a big way. But again, if you look at the, for example, if you have a look at all the fundamentals together, let's have a quick look at the seasonality, for example, if I go to Market Watch. So typically, we see LDPE prices goes down to December. We are expecting a Q4 low point. I would, as a buyer, I would be happy if it goes down to December. I think there's a good chance it will stop already in November this year. In any case, we're avoiding hedging because it's going down a little while longer, but then the risk is an increase to March next year. So this is built in. So this low point may come in November or December. So we avoid hedging until that. But then we need to cover that increase next year. And why is that increase coming? Well, partly because of Brent oil prices are going up, and that's going to affect prices and. So there's a lot of things here. But as you can see, the structure is exactly the same. You have a 3-second view, you have a 3-minute view, and you can dive into all of these. And you only need to go into those when you really say you do have to make a commitment, make a long hedge. Whenever you need, these data are here and ready for you to dive into them. But many weeks you only need the 3 or the 5-minute view, having a look at these. And we, when this here, so you don't even have to go in and monitor the screen all the time, because when this one changes, it will probably change to plan. So that's it. Now we're not starting an uptrend yet, but we're close. So start preparing a plan with your team. What should we do? How should we approach our suppliers? And then it would move either to partial or it would move to full. And that's where you need to squeeze the trigger. And you will get a notification when it changes to plan, and you'll get a notification when it changes to either partial or full. So once you get a mail, something is up and you need to take a look. So that is basically how we are looking at things. And it means that with all of these commodities here, we're doing exactly the same thing. The modeling is the same thing, also for currencies and everything. One final thing, maybe have a quick look at container rates. And this gives me a good, I like to show flaws because you need to understand that we are not perfect. And the thing is that we lock the target in operation is locked. So that way you can see whether we hit it or not. From 6, we expected a target 7 increase. And we have advised to hedge, and basically you've been covered. But you can see that this target 7 says a high target of 4,600. And we're now at 5,000. So we were surprised by the strength of this uptrend. So the good thing about having these targets as fixed is that you can see, well, target 6 was hit perfectly, but target 7 was not. But the best way to look at this, or the proper way to look at this, is a target consists of the trend. It consists of duration, and it consists of amplitude. So if you understand that you are in 6 and you're going to see an increase to 7, that uptrend is what prompts you to hedge, to fix prices or to mitigate it. If I get the trend right, that's the most important thing. Then the second most important thing is duration. Will it last roughly the time that we expect it to, so that you can cover the right time, the time length? And then the last and least important is amplitude. If it gets to this level or it gets to that level, of course, we would like to hit the target. But the idea is that if you mitigated your hedging down here, you are not seeing that increase. So whether we hit the target or not is not really important, because your price is down here. So amplitude is also important, but it's the least important of the 3. But I always show the flaws in the system, because so you realize that, of course, 1 was perfect, 2 was perfect, and so on, but 7 was not perfect. So in container rates, we expect a slight decline, only slight, here in Q4, just like a little pause. And then we expect a further increase into Q1. So a short hedge will be needed once we get to Q4. So everything else in this works the same way. So if I go to container rates and click on forecast, we're looking at the macroeconomy, we're looking at technical analysis, we're looking at the fundamentals of cost drivers and all kind of things. So that's how we do our modeling. So basically, this is in a nutshell for you, that we try to do our best to forecast, and we're totally impartial. We just want to get every single movement right. We know as a buyer, we're having a difficult time, especially in volatile times as these. The only thing I can guarantee you is volatility is not going to go flat. Volatility is here to stay. And it's a constant job of a buyer to be on top. It's a constant struggle. And I think that you are really capable already. I've met so many buyers in so many years, and they have a really good feeling for what the market is doing and what it will do. But still, it's nice to have a tool. So I'm basically saying a chair needs 4 legs, and you are one of the very critical and important legs because you have a lot of industry knowledge. We can just supply the 3 other legs, which is the fundamentals, the technicals, and the macroeconomy. In combination, we can help each other. That's the message here, and not like we get everything right all the time, but we get a vast majority of them right, and that's where the money is. The money doesn't lie in perfection. The money lies in improvement. So today, that was a quick look into 3 different commodities. We will do more webinars where you can see other commodities and we can go more in depth, but this is just like the first tasting. This is the breaking the champagne bottle on the ship and christening it, and I've taken it for a quick spin around the harbor so you just get a feel for how it's looking. So with that out of the way, I will just go back to the slide here in a second, and I'll just say thank you for everything. The next webinars will be published. We'll publish the dates, and there we will go much more into questions. And I like to have a dialogue with lots of questions. We can go into any kind of thing you have in questions, but today is just a short demonstration. But in the meanwhile, you can contact us with any questions and talk to our sales team. You got our phone numbers here, so I'll just be saying thank you from here, and I will look forward very much to talk to you again in the future. Thank you.